The answers are that Bitcoin bonds effectively combine US Treasuries with Bitcoin, with the US Treasuries offering a small yield and investors being compensated for this small yield with higher Bitcoin returns. If you're confused, don't worry. The report gives a simple example to explain how exactly this would work. First, a Bitcoin bond would be issued, and 90% of this bond would consist of US Treasuries offering a low yield, such as 1%, and the remaining 10% of the bond would go towards accumulating Bitcoin. Logically, issuing a 10-year Treasury at a 1% yield would make it possible for the US government to refinance itself well below the current level of interest, which is around 4 to 5% at the time of shooting. Obviously, bond investors would normally not accept such a low yield. They would want a higher return. And that's where the Bitcoin comes in. The rationale is that 10% allocation to Bitcoin will provide the returns that bond investors would otherwise get through yields. The report specifies that investors in Bitcoin bonds would get 100% of the upside up to 4.5% compounded, and 50% of any gains beyond that. As for the remaining 50%, well, this would go to growing the US's strategic Bitcoin reserve. Of course, the reason for providing 100% of the upside up to 4.5% would be to practically act as a 4 to 5% yield that investors would demand from regular 10-year treasuries.